Okay, today we're going to talk about analysis of financial statements, which is chapter 7 in your textbook. Now, for the most part, this chapter is about calculating and using financial ratios, but there are some other tools that we will discuss as well. So, in the previous chapter, chapter 6, we were looking at the financial statements of Computron, and if you'll recall, they had recently undergone a major expansion, and management was not very happy with the way that things appeared to be going. In this chapter, we're going to continue looking at Computron, but we also will have forecasted financial statements for 2019, and this is the subject of chapter 9, which we'll do next, forecasting financial statements. So we're going to use several tools. First of all, financial ratios. You should be familiar with most of the ratios that we're going to look at from Finance 3300. It's always good to have a second look, though. We'll look at trend analysis. So we'll look at trends in financial ratios over time, or income statement items, or balance sheet items. We will look at common size financial statements and common base year financial statements. All right, so let's take a look at the income statement. First of all, notice in this case that we have something new. We have the forecasted income statement for 2019. We did not have this in chapter 6. And by looking at this, you can see that sales are forecasted to continue to grow, this time by about 20% in 2019. And of course, all of their other expenses will grow as well. Well, most of their other expenses will grow as well. But notice importantly that they're forecasting that net income will be positive again in 2019. So assuming that that comes to pass, that's good news for the progress of this expansion. Also notice in the other data here a couple of things. First of all, they're forecasting that the stock price will more than double from what it was in 2018 to $12.17 in 2019. Also notice that the number of common shares outstanding goes from 100,000 to 250,000. So one of the things that we're going to see later on is that in 2018, the firm took on a lot of debt to pay for that expansion. And so they're going to fix that in 2019 by issuing stock and paying off a lot of that debt. On the balance sheet, we can see that total assets is going to grow as well. And a lot of that growth in total assets comes from your current assets. So for example, the accounts receivables and inventories are both going to grow by quite a bit. On the liabilities and equity side, we can see what I was talking about a minute ago. The firm is going to issue a bunch of common stock, and so allow them to reduce the amount of debt that they have outstanding. If you look here, long-term debt is going to fall from $1 million to $500,000. Notes payable will fall from $720,000 down to $300,000. So they're going to do that by selling common stock. So this is what's known as recapitalizing the firm. All right, so let's start to talk about financial ratios a little bit. And before we even get into that, let's talk about what ratios are. So a ratio is simply a way to compare one number to another, and presumably we gain some kind of insight by doing that. And there's two ways that we can do these comparisons. First of all, we could look at the difference, or in other words, comparison by subtraction. So if the number is positive, that tells us that the first number is bigger than the second. If it's negative, it tells us the second number is bigger than the first, and so on. That may be useful. However, most of the time, it's better to do the comparison by division. In other words, create a ratio. And that's really all a ratio is. It's simply one number divided by another. And that tells you how big the first one is compared to the second one. And we can usually draw some conclusions from that. Now, you're familiar with ratios because you use them every day. For example, if you drive a car, you're probably quite familiar with this concept of miles per gallon. That's a ratio. It's the number of miles you've driven divided by the number of gallons of gasoline that you've used. Or if you are into computers, you're probably familiar with this idea of instructions per clock. That's how many instructions or calculations the CPU can do per clock cycle. Again, simply a ratio. Now, in the mini case, they gave us the income statement and the balance sheet, and then naturally they've asked us a bunch of questions. And the very first one is, what three groups use ratio analysis and for what reasons? Well, the first one would be the managers. So managers of the firm use ratios to evaluate and improve firm performance. So if you notice that some ratios are lower than they should be, well, that gives you some information that you can use to start to take corrective action. Creditors use ratios to make decisions on providing financing to the firm. And in particular, they look at certain ratios to decide what interest rate to charge. They might also look at a set of ratios to try to figure out how likely it is that the firm may be bankrupt in the near future. We're not going to talk about that here today, but that's very common. And then finally, the shareholders use ratios to evaluate management of the firm and also to help forecast future cash flows. And remember, ultimately, what we're trying to get at in this section of the course is how to value the firm. And one of the things that we need is estimates of the future free cash flows to do that, and ratios can be a part of that process. Now, the next question that comes up a lot of times is, how do I know if a ratio is good or bad? Well, first of all, let me just point out that you should never make a decision based on the value of one ratio alone. We have to look at them in groups. But more generally, financial ratios are only useful when they're compared to the same ratio over time. In other words, a trend analysis. So you can see if it's moving in the right direction or the wrong direction. Other ratios, so you might look at the quick ratio, for example, and then to confirm whatever conclusion you've drawn, you might look at the inventory turnover ratio. So we need to combine ratios together to be sure that the conclusions we're drawing make sense. And then finally, some sort of representative value for similar firms. We usually call this the industry average. But industry average is a little bit misleading because generally there's too much variation within an industry. So it makes a lot more sense to compare whatever firm you're looking at to other very similar firms. In other words, some subset of the industry. So what is a good value? Well, generally speaking, higher is better for most ratios. However, if a ratio is too high, that's not good either. So for example, the first ratio we're going to look at is the current ratio, which is the ratio of current assets to current liabilities. The higher that ratio is, generally, the better. But if it's too high, that probably indicates that you have too much invested in current assets, and current assets generally earn much lower returns than fixed assets. So too high can be bad as well. There are some ratios where lower values are better. So for example, days sales outstanding tells us how long it takes to collect on a sale. And if it's taken you 6 months to collect on a sale on average, that's not good. On the other hand, if it's taking you 3 days, that may not be good either. That might be too low. That might indicate that you're not granting credit to enough of your customers, and therefore you might be missing out on sales. So we're looking kind of for a sweet spot. Now, the other category of ratios where lower is better are the leverage ratios. These measure how much debt a firm has. And again, generally speaking, too much debt is clearly bad. On the other hand, too little debt may mean that you're not maximizing shareholder wealth. So too low could be bad as well. So as I said, there's got to be a sweet spot kind of in the middle. But for most ratios, generally higher is better as long as it's not extremely high. Now, before we get into the ratios themselves, let's talk about categories of ratios. Now, one thing I want you to be aware of is that there are a number of categories of ratios, but I will never ask you to identify which category a ratio falls into. I just don't think it's that important. So keep that in mind. But the categories are liquidity ratios. These measure the ability of the firm to pay its short-term obligations. So liquidity refers to how quickly and easily an asset can be converted into cash. So for example, accounts receivable can generally be converted into cash very easily. So you either collect on them or you can sell your accounts receivable to a firm known as a factor and convert them into cash in very short order and by not giving up very much of the value. On the other hand, fixed assets, so let's imagine you own a house, for example. Well, if you want to sell your house by tomorrow, you could probably do that, but you're going to have to cut the price that you're willing to take by quite a lot. Otherwise, if you want to get the full market value out of it, it's probably going to take you a while to sell it. So a house is much less liquid than accounts receivable are. So the liquidity ratios focus on the short-term assets and short-term liabilities of the firm. Efficiency ratios tell us how well the firm is doing at using its assets to produce sales. Leverage ratios tell us how much debt a firm is using to finance its assets. Coverage ratios tell us about the ability of the firm to pay specific types of expenses. And profitability ratios tell us how profitable the firm is. Now, let me point out, when it comes to profitability ratios, unlike any other category of ratios, there is no such thing as being too high. There's no such thing as being too profitable. And then finally, we'll look at some valuation ratios, which give us an idea whether the firm is undervalued or overvalued or perhaps fairly valued. So in the upcoming slides, we're going to look at a selection of ratios that are useful in general for most types of firms. However, I want to point out that every industry has its own set of ratios that are useful to that industry, and they may not be generally useful. So as an example, in the transportation business, let's say an airline, revenue per passenger mile is a very important ratio. But you would never use that in the manufacturing industry. It just doesn't make any sense. So we're going to look at ratios that are generally useful. All right, and then before we get into the ratios, let's talk about how they are named, because this will help you to know how a ratio is calculated just by looking at the name of the ratio. Now, I'll point out before I even go through this does not work for every single ratio, but it works often enough that it's useful. So first of all, the word margin means some form of income, net income, operating income, gross profit, whatever, divided by sales. So for example, the net profit margin is net profit divided by sales. Notice that the name of the profit measure is typically a part of the name of the ratio. So when you see net profit margin, you know it's got to be net profit divided by sales. Turnover means sales or some variant of sales divided by whatever else is mentioned in the name of the ratio. So for example, the inventory turnover ratio is sales divided by inventory. And actually, when we calculate inventory turnover, we usually use cost of goods sold, not sales. But cost of goods sold and sales measure the same thing. The difference is sales includes the profit margin in it. Cost of goods sold does not. And so cost of goods sold is actually a cleaner comparison to inventory, which is carried on the books at cost rather than at retail. Return on means an income measure divided by something. So for example, return on assets is net income divided by total assets. Now I just noticed that it says net income divided by sales. I'll have to correct that. It's net income divided by total assets. And then finally, the words per or to can be read as divided by. So I mentioned miles per gallon earlier. That's simply the number of miles driven divided by the number of gallons used. Or debt to equity is the amount of debt divided by the amount of equity. So these rules don't always help, as I mentioned, but they help often enough that it can be, I think, an important tool in helping you to memorize the ratios. And let me point out, the ratios are not on the formula sheet that I give you to do the exam, so you need to have them memorized. Okay, the first category of ratios we're going to look at are the liquidity ratios, and there's a couple of these. And remember, these measure basically the ability of the firm to pay its short-term debts. So the current ratio compares current assets to current liabilities. This is useful because the current assets get converted into cash, which is then used to pay off the current liabilities. So basically, the cash flow cycle works like this. The firm acquires some raw materials. We're imagining that it's a manufacturing firm of some kind. So the firm acquires some raw materials. They process them into a product, which they then sell. But when they sell it, very often they don't collect on that sale immediately. And so that creates an account receivable. That account receivable is typically sits there for a month or so, and then it's collected on, meaning they now have cash, which they can use to pay off the accounts payable that they used to acquire the inventory in the first place. So current assets get converted into cash, which is then used to retire the current liabilities. So it makes sense to compare current assets to current liabilities. And the formula is simply current assets divided by current liabilities. Now, clearly, we would like to see this ratio above 1, and probably generally, and it depends on the industry, but generally something around 2 or more is probably good. And here's the calculations for each of the years. So you notice in 2017, it was 2.33, but it dropped dramatically down to 1.46 in 2018. And it's expected to rebound in 2019. The quick ratio is very similar to the current ratio, but it recognizes that inventories tend to be fairly illiquid. So to understand that, think about when you see a retailer go out of business. Well, as soon as they go out of business, you generally see people out on the side of the street waving signs saying everything must go, all prices 50% off or something like that. What they're doing is they're cutting the price of their inventory dramatically to try to move it much more quickly. And so the quick ratio recognizes that inventory is fairly illiquid, and so it simply sets the value at 0. So the formula really is current assets less inventory divided by current liabilities. And here you can see that it was 0.85 in 2017, dropped a lot in 2018, and is expected to rise to 0.93 in 2019. Notice that the inventories are not really worth 0. So if the quick ratio is less than 1, that does not necessarily signify a problem. It might, but it may not. And so the fact that these are all less than 1 is not necessarily troubling, but the big drop from the current ratio suggests that the firm might have a lot of inventory, and that may be a problem. Now, the efficiency ratios, remember, measure how well the firm is using its investment in various types of assets to generate sales. And this makes sense because the only reason a firm has any assets at all is to generate sales. And sales ultimately, hopefully, lead to profits. And profits lead to cash flows being paid out to investors. So using assets efficiently is very important. Inventory in particular is a very expensive asset to own. And so we want to make sure that the firm doesn't have too much inventory. So this ratio can be interpreted in a couple of ways. First of all, the number of times that inventory was replaced during a year. I don't find this to be terribly useful. Maybe once in a while it's useful to think about it this way, but usually not. A more useful way is to think about it as the amount of sales generated per dollar invested in inventory. And so clearly, the more sales you can generate per dollar of inventory, the more efficient you are. Now, let me point out that if this ratio is very, very high, that might indicate that you don't have enough inventory. And not having enough inventory on hand might lead you to losing some sales. So you can imagine if you go to a store looking for something and they don't have it, what are you going to do? Well, you're going to go to somebody else. And if that somebody else has it, well, maybe that somebody else is going to win your business in the future. So inventory outages are bad as well. So if this ratio is too low, that's bad. And if it's too high, that's bad as well. All right. And remember that this word turnover means sales or some variant of sales divided by something. So this inventory turnover ratio should be sales divided by inventory. And in fact, it is. However, as I mentioned earlier, it makes more sense to compare cost of goods sold to inventory because cost of goods sold is at cost and inventory is at cost. So we don't have a profit margin in between that screws things up. So here's an alternative formula. And this one, these days, I think this one is more common than sales divided by inventory. So, and that's what we're going to use is cost of goods sold in the numerator. And here you can see that in 2017 it was 4, it fell a little bit in 2018, and it fell even more in 2019. Generally speaking, this trend that you see here of the inventory turnover ratio falling signifies that the firm is building up inventory, and that's probably not good. Accounts receivable turnover is very similar to inventory turnover, except, of course, it's sales divided by accounts receivable. Now, an alternative way to calculate this would be credit sales divided by accounts receivable. The problem with that is most of the time we don't know what proportion of a firm's sales are credit sales. So it can be a little bit difficult to have that information. So usually this ratio is just sales divided by accounts receivable. And here you can see, again, this ratio is dropping over time, and that suggests that the firm is having trouble collecting on its accounts receivable. Now, one way that we can tell if they're having trouble collecting on accounts receivable is by looking at a ratio called days sales outstanding. This is also known as the average collection period. And this tells us, on average, how long does it take to collect on a sale. So the formula is accounts receivable divided by sales per day. So annual sales divided by 365. Now note that sometimes you'll see this ratio using 360 days in a year. That goes back a long ways. 360 days in a year is a simplification that we do a lot in finance, and it's known as a banker's year. If you have 12 months, each with 30 days, that gives you 360 days in a year, and it simply makes the math a little bit easier to do. So 365 these days is more common, but it used to be that we always calculated this with 360 in the denominator. Notice here that days sales outstanding was 37.35 in 2017, and it has risen to 45.55 in 2019. That is not good. Let me point out, though, that you need to compare the days sales outstanding to the credit terms that the firm offers to its customers. So, for example, if they tell the customers they need to pay in 30 days and you have a 45-day days sales outstanding, that's clearly bad. On the other hand, if they tell their customers they need to pay within 60 days and they have a days sales outstanding of 45, that's maybe not so bad. But generally speaking, the longer it takes to collect on sales, the worse it is. So this ratio kind of goes in the opposite direction of most of the other ratios. Here, lower is generally better. Fixed asset turnover ratio is simply the amount of sales per dollar invested in fixed assets. So notice the last few ratios we looked at were basically comparing sales to current assets. Here we're comparing sales to fixed assets. And so this is simply sales divided by net fixed assets. And you notice that this was 9.95 in 2017. It dropped a lot in 2018 because remember the firm bought a lot of fixed assets in 2018. And then in 2019, it's expected to get better again. And finally, we have total asset turnover. This takes all of your assets, not just current or not just fixed, but all of your assets, and compares it to sales. So this is sales divided by total assets. Now, as I mentioned, you can use these ratios together. For example, imagine that a firm has a total asset turnover ratio that's lower than you think it should be. Well, then you can go look at the inventory turnover or accounts receivable turnover or the fixed asset turnover and identify exactly where the problem is. And in this case, we can see that the total asset turnover ratio has been dropping, and likely that is because of the buildup of accounts receivable and inventories. Now, the next category of ratios are the leverage ratios, and these describe how much debt a firm is using. Generally, using too much debt is a bad thing. So if these ratios are high, that's a danger sign. So the first one of these is what's called the debt ratio. And I'll point out that your textbook has recently changed the definition of this that they use. And they've changed it in, I think, a non-standard way. So normally, this ratio is total liabilities divided by total assets. In other words, total debt divided by total assets. Here, they're simply using interest-bearing debt. And that's okay. It's just not really the traditional definition of the debt ratio. So total liabilities divided by total assets, they call the liabilities to assets ratio. For our purposes here, the debt ratio is going to be interest-bearing debt divided by total assets. And you can see that this rose dramatically in 2018 because remember, the firm paid for this expansion primarily by issuing debt. And then in 2019, remember, we saw on the balance sheet that they're planning to issue a bunch of stock to pay off a lot of that debt. And so the debt ratio is going to drop quite a bit in 2019. Another way to look at exactly the same thing is to look at the debt to equity ratio. This measures precisely the same thing as the debt ratio, except it's expressed a little bit differently. So rather than interest-bearing debt to total liabilities, here we have interest-bearing debt to total equity. But debt plus equity equals total assets, so this is really the same thing, but the scale of the number will be a little bit different. So here we have notes payable plus long-term debt divided by total equity. And you can see the same picture that we saw with the debt ratio. So in this case, it starts at about 79%, rises dramatically in 2018, and then when they issue a bunch of stock and pay off debt in 2019, it's expected to fall to about 40.5%. The next category of ratios are the coverage ratios. Now, these are similar to leverage ratios, but they measure the ability of the firm to pay a certain kind of financing cost. So rather than just debt in general, coverage ratios look at the ability of the firm to pay its interest expense or all of its fixed financing costs. So the first of these is the times interest earned ratio. And this is simply going to be EBIT, which is the money available to pay interest expense, divided by interest expense. So if you think about an income statement, essentially you have sales minus operating expenses gives you EBIT, and then from EBIT, you subtract interest expense. So in some sense, EBIT represents the amount of money that's available to pay interest expense. One modification you can do to this is to add your non-cash expenses, because remember, non-cash expenses are subtracted out as an operating expense, but they never actually left the firm. So you could have EBITDA, which is EBIT plus depreciation and amortization divided by interest expense. We're not doing that here, but that's another ratio that's commonly looked at. And here you can see that in 2017, they were able to pay their interest expense without any difficulty. We had a times interest earned of 3.35. But in 2018, they did not generate enough operating earnings to pay their interest expense. Now, let me point out, that does not mean that they did not pay their interest expense. They paid it, but they used borrowed money to pay the interest expense. And that's something that clearly is not sustainable in the long run. And that's probably one of the reasons why in 2019 they're planning to issue a bunch of stock to get that interest expense down. And so you can see in 2019, this is expected to be 6.28, which is a much more comfortable margin than 0.1. Now, the EBITDA coverage ratio, this is not what I was talking about a minute ago. EBITDA is what I was talking about a minute ago, but this is not about paying interest expense or not just interest expense. This is really about paying all of the firm's fixed financing costs. So that would include lease expenses as well as preferred dividends. So another name for this ratio is the fixed charge coverage ratio, because it's not just interest that we're paying here. Now, the formula looks a little bit complicated, so let me break this down for you. First of all, let's take the numerator. We have EBIT plus non-cash expenses. That gives us EBITDA, and then plus the lease expense. In the denominator, we have interest expense plus lease expense plus preferred dividends on a pre-tax basis. Now, let me explain a couple of things here. I think interest expense is fairly self-explanatory. Clearly, that's a financing charge. Lease expense is also a financing charge, but you might ask, well, why is lease expense in the numerator and in the denominator? Well, first of all, if we were multiplying, it would cancel out. We're not multiplying, though, we're adding. The reason we add lease expense back in the numerator is because it was subtracted out in the calculation of EBIT, and it's one of the expenses that we want to cover. So we need to have it in the denominator, and in order to make a fair comparison, we have to add it back in the numerator. Preferred dividends divided by 1 minus the tax rate tells us how many dollars do you need on a pre-tax basis in order to pay your after-tax preferred dividends. Remember, preferred dividends, like common dividends, are paid out of after-tax dollars. So we need to convert this to pre-tax dollars to know how much we have to cover. And so you can see, just like the times interest earned ratio, this one started out at what seems to be a reasonable number, 2.61, fell quite dramatically in 2018, and then it's expected to rise a lot in 2019. Now, the next category of ratios are the profitability ratios. Now, there are a number of ways to measure the profitability of the firm, and so we'll go through several of them here. So the first three we're going to look at concentrate only on the income statement. And what we're doing is we're taking each profit measure from the income statement divided by sales. Remember, the word margin means some profit measure divided by sales. And so the gross profit margin is simply gross profit divided by sales. So this is before subtracting any of your operating costs. Gross profit, remember, is sales minus cost of goods sold. So this gives us a gross measure of the profit, or the profit that's available to pay operating expenses, interest expense, and taxes. So the gross profit margin has been fairly stable, from 16.5% down to 14.5%, and then back up to 17.5%. So there's some variability. It suffered a little bit in 2018, but not too bad. The operating profit margin looks at operating profit relative to sales, and operating profit is just another word for EBIT. So we have EBIT divided by sales. Now notice, if the operating profit margin is too low and the gross profit margin looks good, that suggests that the problem is your operating costs are too high. And so in this case, we have the operating profit margin fell a lot in 2018 and is expected to recover quite a bit in 2019. Now, the net profit margin, that takes net income or net profit divided by sales, and this is the bottom line. So if your operating profit margin looks good, but your net profit margin is bad, that suggests that either you have too much in interest expense, which implies that you have too much debt, or that you're paying too much in taxes. So this is simply net income divided by sales, and we can see that this was 2.5% in 2017. It went negative in 2018, and then it's expected to rebound quite nicely in 2019. There are still other ways to measure profitability, and the rest of these that we're going to look at compare an income measure to some balance sheet item. So the first of these is the basic earnings power, and this is simply going to be EBIT divided by total assets. So this is very similar to the next one that we're going to look at, which is return on assets, but we're using operating earnings rather than net income. So here you can see basic earning power was 14.25% in 2017, fell to almost nothing in 2018, and then it's expected to rise back up to about the previous level in 2019. Return on assets is a very widely used measure of profitability, and simply it is net income divided by total assets. And you can see it was about 6% in 2017. It was negative in 2018 because net income was negative, and then it's expected to rise to about 7.25% in 2019. Return on equity is another similar measure, but it looks at net income relative to common equity. This makes sense because the goal of the firm is to maximize shareholder wealth, so they should care the most about the shareholders, which means the equity in the firm. So this is simply net income divided by total equity. And you can see 13.25 in 2017, quite negative in 2018, and then back up to almost 13% in 2019. This is probably, from the shareholders' point of view, the most important measure of profitability because it tells you how much profit they're earning on the money that was supplied by the common shareholders. Now, the last category of ratios we're going to look at are the valuation ratios. And the idea here is we want to know if the firm is undervalued, fairly valued, or perhaps overvalued. This is particularly important for potential investors deciding whether to buy a stock or not. Now, like most of these other ratios, this doesn't tell you a whole lot unless you compare it to PE ratios of other similar firms. So it's hard to know if a company is undervalued or overvalued without thinking about the relative valuation of other companies. So this is simply the stock price divided by earnings per share. And you can see that Computron had a PE ratio of 9.66 in 2017. The negative number in 2018 would usually be published as not meaningful or something like that, because a negative PE ratio really doesn't tell you anything. And then they expect this to rebound quite a lot in 2019 because they expect the stock price to rise a lot. Now let me point out that this 2019 number, this is based on what the management of the firm expects the stock price to be in 2019. And honestly, nobody has an idea of what the stock price is going to be next year. I mean, you can come up with an idea, but you don't know exactly what it's going to be. So this is potentially a little bit misleading for 2019. Price to cash flow is the same idea as price to earnings, except we use cash flow per share instead of earnings per share. Cash flow in this case is defined as simply net income plus non-cash expenses. And so the ratio is stock price divided by cash flow per share. And here you can see the results. Now notice, unlike the price to earnings ratio, this one actually rose in 2018. The reason for that, remember, is that they went out and they acquired a lot of fixed assets, and that generated a lot of depreciation. The last one we're going to look at here is the price to book ratio. So this is the price per share divided by the book value per share. This is also known as market to book. And this is an important ratio because the stock price is the market price of the stock, and the book value is the value that the stock is carried at on the balance sheet. And here you can see that this ratio has been much more stable than, say, the PE ratio or price to cash flow was. All right, so what do you do with these ratios? Well, you compare them either to the same ratios for the firm over time, or actually, and compare them to industry averages. So the idea here is that presumably the average firm in the industry is doing things correctly. Therefore, the industry average ratio is pretty much the correct value. And so you can see whether your firm is doing worse than or better than the industry on average. Now let me point out something here that's important. When we talk about industry averages, you can calculate industry averages, but it's usually much more useful to calculate an average of a small subset of the industry. For example, the 3 to 5 firms in the industry that are most comparable to the one you're looking at. Very often there's a lot of variability between the firms in an industry, and there's also different ways to define an industry. And so if you look at every firm in an industry, a lot of times many of those firms you wouldn't even think are comparable to the firm that you're looking at. So what you really want to do is identify the top 3, 4, or 5 comparable firms in the industry and average their ratios together. Now, they've given us here a table of these ratios and the industry averages, so we can compare Computron to the industry averages. And there's several things that we can note from this table. First of all, liquidity has always been a problem. So if you look at the current and the quick ratios, they are always less than the industry average. So that tells us that Computron has a liquidity problem. Secondly, managing accounts receivable and inventories has always been a problem. So you see that the inventory turnover ratio is far less and getting worse compared to the industry average. Day sales outstanding, which looks at accounts receivable, is always higher than the industry average. So that tells us it's taking considerably longer for Computron to collect on its sales than the average firm in the industry. We can also see that up until 2019, Computron has had a lot more debt than the industry. So if you look at the debt ratio or liabilities to assets, you can see that clearly. Also, if you look at the coverage ratios, they are always less than the industry average, at least until 2019, when the times interest earned ratio is a little bit better than the industry average, and that's because they paid off a lot of debt. And finally, the profitability has always been low relative to the industry, and so that's not good. So we notice a number of problems with Computron, and those problems are what lead to the firm being undervalued relative to the industry. So the PE ratio, even in 2019, is 12, but the industry average is selling for 16 times earnings. So Computron is undervalued. Now, I should point out, usually when you spot an undervalued firm, undervalued according to PE ratio or some other valuation ratio, there's a reason for that. So it's not like the market is stupid and hasn't recognized the value of Computron. It's discounting the value of Computron because of these problems that we've identified. Okay, now one of the important ratios that we talked about was return on equity, or ROE. And so the DuPont method is a method that's used to decompose the ROE into its parts. Now there's two versions of this that we're going to look at. The first one is kind of the standard DuPont breakdown of the ROE. And this is useful if the firm believes that its return on equity is lower than it should be, because it helps us to identify the things that need to be fixed. So the DuPont method says that ROE is the net profit margin times the total asset turnover times the equity multiplier. And the equity multiplier is just another measure of leverage. The first two terms here, the net profit margin times the total asset turnover, that gives us the return on assets. And so it's important to note that the ROE is simply the return on assets times the amount of leverage that the firm is using. So if you have a firm that uses no debt at all, then return on assets and return on equity would be the same. And the more debt they use, the bigger, assuming they're profitable, the bigger ROE would be relative to ROA. So we know that ROE is low for Computron. So we can look at the net profit margin, the total asset turnover, and the amount of debt that they use to identify exactly what needs to be worked on. And in this case, it's really primarily profitability and using assets efficiently. Now, I'm showing you here the calculations for each of these 3 years, but let me point out, nobody would ever calculate ROE this way. This is a diagnostic tool, not a calculation tool. So the DuPont method helps us to identify where the problems are, not so much how to calculate ROE. You could calculate ROE this way, but it's much simpler to simply take net income divided by total equity. The advanced version of the DuPont method takes that net profit margin and breaks it down into 3 components. The operating profit margin, which is just EBIT divided by sales. The interest burden, which is earnings before tax divided by EBIT. And the tax burden, which is net income divided by earnings before tax. Multiplying those 3 things together will give you the net profit margin. The total asset turnover and the equity multiplier are the same as they were in the regular DuPont method. So our formula here is operating profit margin times interest burden times tax burden times total asset turnover times the equity multiplier. And if you work through this and you cancel out everything that can be canceled, what you're left with is simply net income divided by total equity, which is the return on equity. So again, this can give us a finer breakdown so that we can better identify exactly where the problem is. Okay, so that's enough of the financial ratios per se, but let's look at some other financial statement analysis tools. And we'll just go through these quickly, but the first one is trend analysis. So all we do here is we take some variable from the income statement, the balance sheet, or perhaps a financial ratio, and we chart it over time. And we may create a chart which has several of these items so that we can compare them. In this case, I'm showing you 2 trend lines. We have sales over time and the debt ratio over time. And you can see that sales has been steadily rising and the debt ratio rose in 2018 and it's expected to fall quite dramatically in 2019. So we can look at these trends and draw some conclusions about whether the firm is moving in the right direction or the wrong direction. Now, one thing I should point out is that the more data you have here, the better, because these short-term movements can be very misleading. So usually you want to have at least 5 years worth of data. If you have more than 5 years, that might be good, but it could be that the firm has changed a lot. So if you go back, say, 10 years, the firm might be very different today than it was 10 years ago, and that might invalidate your trend analysis. So you don't want too much data, but you don't want too little. And I think in the mini case here, we have too little data. Another technique that we can use is common size financial statements. And so the common size income statement is simply everything divided by sales. So we're looking at everything relative to sales, and this allows us to see these trends very clearly. So for example, here you can see that cost of goods sold rose in 2018 and it's expected to fall in 2019. Same thing with net income or any of these other items. You can see kind of at a glance. Common size income statements are also very useful for comparing to other firms in the industry. It can be very misleading to just look at dollar amounts. So if you look at a big firm and a small firm, well, the big firm almost certainly is going to be more efficient and probably more profitable, but it can be difficult to see that when you look at the dollar values. So looking at percentages makes that more clear. Common size balance sheet is the same idea, except that everything is compared to total assets instead of net income. And here we can get a good look at how these things are changing over time. So for example, accounts receivable, you can see that it actually fell relative to total assets in 2018, but it's expected to rise to almost 25% in 2019. That's probably not good. And remember, we've already identified that as a potential problem area. Similarly, with inventories, they are expected to rise to 48.8% in 2019. Now, if we look down at the bottom, you can see very clearly that long-term debt is going to be much lower in 2019, and common stock is going to be a higher percentage of total assets. So much of this we've already identified from the ratio analysis, but this is confirmation of what we've concluded. And again, if you want to compare financial statements from one firm to the other, it's better to do it on a common size basis than just dollar amounts. Now, another tool that we can use is a common base year financial statement. So what we do here is we compare everything to some base year. So in this case, we're going to look at 2017 as the base year. And so you notice that everything in 2017 is 1 because that's our beginning value. And then we take the value of, let's say, sales in 2018 divided by 2017 sales. That gives us 1.7. Remember, we saw in the last chapter that in 2018, sales rose by 70%. And then we do the same thing for 2019. We take each 2019 value divided by the corresponding 2017 value. Notice also that if you subtract 1 from these numbers, you get the percentage change since the base year. So for sales, we can see at a glance that sales rose in 2019 to 105% of what it was in 2017. And you can do the same thing for all of these others. The balance sheet works exactly the same way. And I think that will do it for the lecture in this chapter. As usual, I'll take a quick look at the spreadsheet for the mini case in chapter 7 next. Okay, this is the spreadsheet that I've put together for the mini case in chapter 7. And as usual, we've already gone through most of the material in the spreadsheet in the lecture. So there's no need really to spend a whole lot of time looking at the spreadsheet, but I'll go through some of it very quickly here. So up at the top, you can see that I have all of the ratios that they gave us in the textbook, and I've calculated them for 2017, 2018, and 2019. I can't calculate the industry average, so I've just taken what they've given us there. But you can work through this and you can see exactly how each of these ratios was calculated. And to help you with that, I also have the income statement and the balance sheet. Now, below that, I have the DuPont analysis, just the plain original DuPont analysis. And then below that, I have the advanced version. And then finally, I have a few ratios that are very common. And I believe I mentioned all of these in the lecture, but they were not included in the set of ratios that were given to us in the mini case. Those are there so that you can verify how to calculate them. Now, I also have the common size income statement, common size balance sheet, common base year income statement, common base year balance sheet. And then I also have the percentage change income statement and percentage change balance sheet. These are not terribly useful, so I probably wouldn't spend any time on those. So the main thing is to go through and make sure that you understand how to calculate all of the ratios and the DuPont analysis and the advanced DuPont analysis, and then perhaps also understand what trend analysis is all about. Okay? I think that'll do it for Chapter 7. I'll see you next time with Chapter 9.